Well, good afternoon. Really appreciate you guys coming to learn more about Research Solutions. My name is Roy Olivier. I'm the CEO. With me is Bill Nerthen, the CFO. And we'll walk you through what we do. I'm gonna have to wear glasses to be able to see this, so apologize to be looking over my glasses at you. Let's start off with what do we do? Basically, we are an end-to-end AI and SaaS software platform that supports research-intensive organizations. Those can be corporations, which is about 75% of our trailing 12-month revenue, or those can be university libraries, which is 24% of our 12-month revenue. Our mission is to advance the world's knowledge by simplifying research. A little bit on the investment opportunity. We participate in a large and growing market, really driven by a lot of seismic changes in how people do research. Of course, the largest one is AI, which we'll talk about a little bit later. We have stable, non-cyclical demand from mission-critical R&D organizations around the world. We have a dedicated SaaS platform, which leverages a large database, some of which is proprietary, as well as a very advanced, it's actually the most advanced AI engine out there today to drive research productivity. We also have strong financial momentum as we transform the business from a transactional business to a recurring revenue business. We have a large, deeply entrenched customer base with about 1,500 customers globally today, most of which are in Europe, Middle East, Africa, or North America. And we have a multi-lever growth strategy, which combines our focus on organic growth with layering in M&A that makes sense to extend our product strategy or help us drive additional growth. A lot of the execution since Bill and I joined the business in FY22 has really started to show in our results. The left column, you can see the company's average results from FY17 to FY21. And as we started 22 to current, we've pretty significantly changed the business in that back in the day, it was a literature access platform. Today, it's a vertical SaaS and AI platform supporting research-intensive organizations. Top line has grown from 5% CAGR to 15%. Revenue stream in terms of SaaS revenue has grown from a little bit under 6 million to over 19 million. I think a key metric we watch is what percentage of our total revenue is SaaS recurring revenue versus transactional revenue or overall revenue, grown from 16 to 36. As a result of that, our gross margins have improved dramatically from around 32 to 47, as has our profitability going from about 700K to 5 million EBITDA. And because of some of the changes we're making to the product, adding additional products, and expanding our focus, we've expanded our TAM from sub 1 billion to about 15 billion today. Our customer reach has really improved by about 50%, and a lot of the expanded TAM as a result of the last item, the expanded market focus, where we've gone from really 3 verticals or segments that we supported to 13. And within that 13 is a corporate segment, and we actually have installs in 60 different verticals underneath the corporate umbrella. What do we do? Well, when we think about research, we think about 4 pillars of research: discovery, access, managing the research once I acquire it, creating my own peer-reviewed document, or creating my own drug to be patented or to be submitted for approval, as well as an underlying level of analysis that applies to every one of those steps. We acquired about 15, 16 months ago a company called Scite, which has an advanced discovery engine. It's sold via subscription, which is what the blue thing says if you can't see it in the back. Access is our oldest product, Article Galaxy. Think of that as iTunes, only instead of connected to music, we are connected to 200 million peer-reviewed scientific, technical, and medical peer-reviewed articles from 2,000 different publishers. So you can go in, find what you want, and very quickly acquire it. We have a tool called References, which helps you manage that content once you acquire it. And on the create side, we have some limited capability today, but it's really a future focus in terms of building a product for that segment. But in the analysis area, Scite also has a very advanced AI analysis engine, which has made it actually the fastest growing product in our offerings today. What's driving all this? Well, really the volume of research is exploding, and as AI came out, so have hallucinations. And as you might, I went too far, sorry. And as you might imagine, getting bad results, if you're a research-intensive organization, from a hallucination is not a good thing. And if you use some of the off-the-shelf AI tools that are out there that search not only what they can find in terms of scientific research, but they also index the general internet, then you can get results that look like a peer-reviewed scientific article. It actually has what's called a DOI number. Think of that as an SKU number for an article, but it doesn't exist. And what Scite does, which is very unique, is we focus exclusively on STM content. Therefore, we have very, very low hallucinations. I'm not going to bore you through the product demo on the left side today, but any of you, as you think about your investment and build out your models, if you'd like to see a demo of our products, you can reach out to us and we'll get you set up. But on the right side is really the important thing. What Scite has today, which OpenAI and all the AI engines do not have, is that not only do we have the ability to index, full text index and search open access, which are the free articles, or abstracts, which are the summary of the articles, but we have the ability to do full text search, what's called citation metrics, and purchase articles throughout a vast majority of the world's content. In short, it means we can search stuff in front of the paywall and behind the paywall, whereas most AI engines today only search in front of the paywall or via the abstract. Our SaaS platform today offers a number of benefits for researchers. Basically, the value proposition of our core offering, which is finding documents, acquiring them, and managing them, is save time and save money. We save a material amount of time on a researcher-by-researcher basis, and that adds up given the fact that researchers are some of the highest paid folks in the organization. And we can save a tremendous amount of money over time by helping companies make better decisions about where do I subscribe, where do I prepay for discounts called a token package, and how do I ensure that my research organization in Europe is not buying something I've already bought in North America or somewhere else in the world. So typically our oldest customer cohorts show a very significant savings year over year, even 7, 8 years later. On the academic and corporate side, some of those ROIs continue to exist, but the average cost savings are material. We can help reduce article spend, eliminate duplicate purchases, et cetera. To deal with one of the elephants in the room, I'm sure you've all heard about the Trump administration's cut to scientific research in a lot of segments. As I mentioned, academic is our fastest growing segment, and it's about 23-24% of our trailing 12-month revenue. We actually think, but we won't know, I think for a couple of more quarters, that what he's doing will be a tailwind to our business. And let me tell you why. One of the largest checks written out of these university libraries is subscriptions to all of the major publishers. In some cases, they're writing 7-figure, 8-figure checks for these subscriptions. Even a small library is writing 6-figure checks. What we can do is provide an exit ramp to save money on some of those subscriptions, but still have access to that document on a document-by-document basis. Think of it as subscribing to Paramount versus just renting the movie on iTunes. So we think that we actually will see a benefit from this in the core Article Galaxy product, which is the Access product. And on the research side, these same libraries typically are spending 6 figures for very advanced search products that have search capability that is parallel to what Scite does. Scite, being a relatively new entrant into the business, into the university library space, is a lower cost product than the entrenched competitors. And so we've seen a lot of great progress and success with that product that we've reported in our previous quarterly results. By the way, our quarterly results will also be updated in about 2 weeks, and I'll talk about this in detail in that call. So as a result of that, today we're trusted by, as I mentioned, 1,500 organizations around the world. About half of our business is pharma, biotech, medical device. The other half of the business is across about 60 different verticals. That includes university libraries, which I mentioned is about 23-24% of our TTM revenue, as well as a number of multinational companies. And today we serve companies from 5 or 10 seats, very small research organizations or startups, all the way up to some of the largest pharmaceutical companies in the world. As I mentioned, our core ROI with Article Galaxy, our oldest product, is time savings and cost savings. And here's one of our customers commenting about what it's done for them. And on the site side, what we do is we allow that organization to really focus on executing against their initiative as opposed to trying to make sense out of 200 million articles and how they relate to whatever initiative they have internally. Let's talk about market opportunity for a minute. I mentioned earlier, we think our TAM is about 15 billion. We today have two segments that we report. One is B2B, which is a university, library, or a corporation. The other is B2C. Those are individual researchers that subscribe to the platform. The B2B business for us is about a $4 billion TAM. The individual researcher, as you might imagine, with the number of universities and students going to school in the world, is about an $11 billion TAM. I will comment that we do not count everyone. We only count what we consider to be a research-intensive organization. What that means is if a university has never published any scientific research, they're not in our TAM. If a company has never produced any scientific research, they're not in our TAM. And on the B2C side, we actually took a significant haircut to the total number of students and focused exclusively on advanced degree students in scientific, technical, or medical space. As I mentioned before, the research-focused SaaS business is projected to grow at about 19% over the next few years, which is a nice tailwind for us. We do believe that research-focused SaaS is underpenetrated, and we've been able to service that. And lastly, once we acquire customers, they're typically highly stable. We have net renewal rates over 100%, and we typically have customer relationships that go on for, in some cases, 15, 18 years. When you are doing your research, all that fine print at the bottom is links to where we came up with the TAM. So if you have questions about how do we figure that out, it's all in the links. Nearly every industry can benefit from our platform, but the common denominator is industries and corporations or universities that are research intensive. As I mentioned, we do serve a number of vertical markets today, but the common theme is research intensity. And we can serve organizations ranging from small startups to multinationals. That means we have, and Bill will talk about this in a few minutes, we have very little dependency on a few customers for our revenue. We've got a tremendous amount of revenue diversification across the business. What's going to happen in a downturn? We've all, I think, lived through some of these downturns, and in the research we did, research never stops. Even in the 2008 downturn, there was a slight decline in research in the 2008, the quarters right after that. But then it's continued to increase again very quickly after that slight downturn. I'll also say that we're certainly having a lot of conversations with the university libraries about the impact on their budgets from what's happening in Washington. On the corporate side, in the last month, our teams have met with a number of customers, including I personally have met with some of our largest customers, and they're continuing to plow ahead with building their pipeline of drugs or whatever it is for the future. Business model, we have two revenue segments that we report on. One is transaction, that is the sale of the actual scientific article. The other is platform, which is any of our software solutions that are sold under typically an annual recurring revenue agreement. Transactions today are about 64% of our revenue. It's the sale of an individual article. The revenue is generated by a transaction. And by the way, when you buy the platform, you're still buying the articles. You don't get any articles as part of our platform purchase. You simply have access to be able to buy them in one place. And the growth and margin characteristics of the transaction business are very different from the software business. Transactional business for us is a flat-ish business. It's very low margin, 24-25% gross margin, but it throws off cash flow and EBITDA that we use to fund the platform business. Platform business, on the other hand, cloud-based, typically annual contract agreements, 85% gross margin, highly stable, and it's been a big growth engine for us. In fact, if we just take a look at the last few years, platforms 85% plus gross margin, renewal rates over 100% in terms of net renewal rates, and key characteristics, 46% growth CAGR, highly stable, predictable cash flows, 85% gross margins, scalable, and I think there's ample room for us in terms of expanding, continue to grow the business given the size of the TAM and our market penetration, which is in the single digits. Transactional business, it's a great business in terms of helping us fund what we're trying to build out on the software side. While it is a lower margin business, it is a steady stream of cash flow that we reinvest into the SaaS platform business. And it's a non-cyclical business in that our transactional business is pretty flattish. There's a little bit of variability, a little bit of seasonality to it, but it's been a pretty stable business, as you can see from the chart. Some of that growth in the chart came from an acquisition. Some of that growth comes from new customers as we onboard the software side and they start buying transactions through the platform. Let's talk about our moat for a second. We've got a number of moats. First off, we do have what we believe to be the world's most advanced and trusted AI engine for research. That is the Scite product. Again, be happy to give you a demo, but we do some unique things with Scite and the AI that nobody else does today. For example, if you're in the research business and you're researching a particular topic, an article pops up, tells you how many times that article's been cited. Doesn't tell you anything about what that means. One of the unique things that we created with Scite, which actually we now provide back to a number of publishers that put it behind their paywall on their site, is we provide not only the number of times the article's been cited, but we tell you how many times that other article agreed with this article, how many times it did not agree, how many times it was just mentioned, etc. So it gives you what we like to refer to as either a FICO score or a Rotten Tomato score for the article you're looking at. Did it come out of a paper mill and it's a low quality article, or is it a highly cited, highly confirmed article from other research out there? So some other things is 85% of all the content in the world today you can access through our platform pretty much instantly. And the other 15% we can get for you. It just may take us 1, 2, 3 days. In fact, the STM publishing business has been around for more than a century. We're one of the very few companies that actually have runners that will go to a library to photocopy something out of a book if you need it. On the publisher relationships, we've been around about 15 years. We have relationships with virtually all of the large publishers in the space, and we have 2 different relationships. One is being able to sell their content through our Article Galaxy platform that's existed for a long time. The other is, can we full text search within Scite their content? On the availability side, we can deliver 99% of the world content today. On the search side, we can search a majority of the content in the world, whether it's in front of or behind that paywall. And finally, we have very sticky customers with high renewal rates that have given us a lot of our stability over the years. I'm going to speed up a little bit here, but here's a listing of some of our publishing partners, publications, and awards we've won. We'll continue to focus very heavily on maintaining those relationships because they are key to our business. I'm going to ask Bill to come up and walk you through the financials.
Thanks, Roy. Yeah, so the next slide here really just shows the transformation that's going on in the business. It highlights the 2 revenue segments that we have, and you can see up at the top, that is the ARR growth of the business, and that is now growing 20% plus organically. Transactions, slower growth, lower margins, but very stable, sticky business as well. And really what you're seeing is this transformation that Roy talked about. The ARR business, that SaaS business, is 85% gross margin, right? And it's also got a 100% plus net retention rate. And so that is starting to impact the blended gross margin of our business. Whereas, I would say about 2 years ago, our SaaS mix was about 24%. Our blended gross margin was about 39%. Flash forward to our last quarter, our SaaS mix is now 39% of the revenue, and the gross margin has moved to 49% on a blended basis, and that will soon cross 50% blended gross margin. So it's really this transformation that's underway, and the momentum in the ARR is transforming the bottom line of the business as well. And that's what you'll see on this slide here. The green is cash flow from operations. The blue is adjusted EBITDA, and you can see how dramatic the transformation has been in the business. We're now at $4.6 million of adjusted EBITDA on a trailing 12-month basis, and we have actually more cash flow from operations than that, so about $5.8 million. So nearing $6 million in cash flow from operations, and you can just see, you know, how that compares to a couple years ago in the business. So this is the payoff of that transformation, and it is accelerating at a faster pace than our revenue growth. We will report numbers in a couple of weeks. We've already said publicly that as we anniversary these numbers and roll a new TTM forward, we expect these numbers to improve. And so there's just a great deal of positive momentum, not only on the top line, but also on the bottom line of the business. And this just gives you a snapshot of our balance sheet, which is pretty healthy. You know, when we did the site acquisition back in December of 2023, our cash balance dropped down to $2.7 million. You can see 1 year later, it's back up to $7.7 million, so $5 million. And actually, in the next 6 months, this is as of a December 31st end date, January to June is typically our best time for cash flow. So you're going to see some dramatic improvement in cash flow over the next 6 months, as well as in that cash balance, which will continue to improve. And that's important because it does give us flexibility to do more things like M&A and strategic things with the business. We do not need any of that cash balance to fund our organic growth or our organic growth plan. That can all be funded through cash flow. We have been acquisitive in the past. We are looking at things all the time, and this is just giving us, as time goes on, more and more flexibility to be able to do strategic things from an M&A perspective. We also have, as is noted here, some NOLs as we turn more profitable to sort of help shield some of the cash taxes associated there. Last is just some valuation metrics and some stats on our ownership. I won't go into too much detail here as this is all publicly available information. I think I'll just end with saying we do believe when you look at the organic ARR growth, the TAM that we have, and the momentum in that business, and the fact that we're growing cash flow EBITDA at a faster pace, we do feel this is a pretty compelling investment opportunity at these levels. So I think I'll turn it back to Roy.
Thanks, Bill. Yeah, I want to leave some time for questions, so I'm going to kind of blow through this. I will say this deck is available at Planet MicroCap. We'll also do an 8K. If it's not already up, it'll be up shortly. That'll have this deck available. But basically what we expect going forward is we expect that transactional business, which is a $30 million business today, to be flat-ish. I have said publicly that we expect our SaaS business, which is about 19 million of ARR today, to be 30 million in 2 years. So if you have a 30 and 30, 30% transactional business, 24.5% gross margin, you got a $30 million SaaS business, 85% gross margin, then when you start to look at that impact on the bottom line, you start to see double-digit EBITDA margins on the bottom line that are in the 20s. So we're very excited about what we're doing, and how we plan on deploying our capital is to continue to focus on organic growth. We just brought in a new chief revenue officer. We've actually hired a bunch of new salespeople, and they're starting to show up in our results. Super excited about what they're doing. We have a very active M&A program. We've done 2 software deals and 1 customer buy in the last 18, 24 months. We'll continue to look for those, but we're at that painful size where it's hard to do a bigger deal, and the smaller deals are too small for us to deal with. You know, we don't need pre-revenue. We don't need somebody's, you know, $600,000 thing. We're looking for things that are going to be accretive to our EBITDA targets and our growth targets. So we continue to look, and we found some very interesting things, but nothing to report. And to the extent that we can't do A or B, then we're going to look at C, which is start buying back our stock with our cash, because especially at where the stock is now, which we think is ridiculously low, given the fact it's 2 times our revenue, then we'll look at other options to use that cash for. So at this point, I'm going to just leave this up as a summary and open it up for questions. Yes, sir. Most of our publisher agreements are 1 year or longer. They charge us a cost. We sell the article. We send them checks either monthly or quarterly. We have a couple of publishers we pay annually in advance. But for the most part, it's been a long-standing relationship where they get a quarterly or monthly report from us with a check. Other questions? Yes, sir. Yeah, first off, when you use our tools, we typically only look at ST content. We don't look at the internet. So we don't look at somebody's opinion. We don't look at some fake article out there. It's all peer-reviewed STM content from a legitimate publisher. We also score that content. I mentioned the FICO score or Rotten Tomato score. So you can very quickly see. I was in a meeting recently with one of the big pharmaceutical companies in Germany, and the guy, as soon as the article pulled up, he goes, yep, that's not an article I want, because we show supporting, contrasting, plus the number of times it's been cited. So they can very quickly evaluate the quality of the article they're looking at. And that's also footnoted in the research report that we generate out of the AI. Unless it comes from a publisher, it wouldn't be in our database. One last question? Yes, sir. No. Thank you for your time.